Hello and welcome to a very special edition of Indianomics. We are glad to announce that the March CPI number has come in at 3.34 compared to a CNBC-TV18 poll of 3.59 or nearly 3.6%. And this is also much lower than the 3.6% that we got in February for the headline inflation and the 4.26% headline inflation we got for January. So it's a clearly falling trend. 3.34, more importantly, is way below the MPC mandate, which is to keep CPI inflation at 4%. So it's a good 66 basis points below the mandated number. Importantly, this inflation number has come down because of a sharp fall in food prices to 2.69%. We don't know when last food prices were as low as that, probably 3-4 years ago. And that's what has helped inflation come down so sharply. Does all this mean that we are going to expect a sharper than, the 5.5% repo rate that everyone is expecting the Reserve Bank to take the repo rate to? Will we expect a double cut in June itself or 50 basis? For all those questions, I'm joined by an elite panel of economists: Aditi Nayar, the chief economist, ICRA; Devang, Shah, the head of fixed income at Axis Mutual Fund; Radhika, the executive director at DBS Bank; and Narang, the head of economics research group at ICICI Bank. Ladies and gentlemen, thank you very much for joining me. Samir, if I may start with you. This is far lower than expected, 3.34. Are you revising your full year numbers? Are you revising your next quarter numbers for inflation?
Well, Latha, we were at 3.44. So, yes, it is 10 basis points lower than our trajectory, but still very close. So, not much. Next year, we are at 3.9%. That's 10 basis points lower than RBI's trajectory. Baseline could be lower if oil prices are even lower than what we have forecasted, around $70 a barrel. So if it remains at 60-65, some more easing is possible if pass-through is there. Otherwise, the government may just choose to erase excise duty as what it has done over the last week and use that to spend more to spur growth. Okay.
Radhika, what is your take? At 3.34%, we are a distance below what the MPC is mandated to keep the inflation at. Are these numbers strong enough for the Reserve Bank to come in with a 50 bips cut in June?
Hi, Latha. Certainly, we were also on the lower end of the forecast range. So it's quite interesting to see that's about 3.3%. And I think food, as expected, has been the main reason why inflation is at these levels. We were tracking actually food inflation. It has been punching above its weight for almost a year plus now. Now, finally, you see it punching below its weight. That's why there's a counter effect. And to your mention, absolutely, not only the March 25 quarter is a cool 70 basis point below where the RBI expected, but also it puts the FY25 inflation weaker than and sets FY26 trajectory on the lower end as well. We are at about 4%, but I think we'll have to revise down the FY26 number in the coming days. Going back to your RBI question, I think certainly keeps the door open for policy easing. But I think the central bank would still prefer to be, calibrated and incremental in its approach. So I would still think that they would go for a 25, perhaps do more rather than, in terms of the next few meetings, than to do more at a meeting. And I think what that really goes down to what's happening in the global environment. Luckily, the currency is under control, but otherwise, certainly, they would prefer incremental moves.
Okay. I'll come back to you for more. But I just wanted to add another bit. Let us get the core inflation number coming up. That's come in at 4% compared to 4.1 in the previous month. But the way core inflation is counted, you also include gold in it. It comes under personal services in India. And because gold prices have shot up, you have a 4% core inflation. If you deduct gold, then core inflation also falls to 3.22. So even the argument that core inflation is above 4% doesn't quite hold at this point. Core inflation also ex-gold would work out to 3.2%. So Aditi Nayar, that question to you. First question, will you reconsider or even have a lower FY26 number?
Thanks, Latha. Well, certainly today's number has come in lower than what we had forecast, and we're now looking at a number of around 3.5% for the current month. This is an interesting month. While a lot of vegetables are still tracking quite modest numbers in month-on-month terms, if there is a pickup in temperatures, we could end up seeing a very rapid increase in perishable prices, as we have seen in the last in the month of April and May in several years in the past. So I think we shouldn't really go by the first half of the month in terms of how the food prices are tracking, particularly for perishables. As of now, we're looking at a 3.5% for April. So a cut in the June policy, of course, is clearly on the table. I agree with Radhika. It should be in incremental steps instead of being front-loaded. So possibly now we were looking at a 50 basis points cut spread over the next 3 policies. I would say now it's going to come in the next 2 policies. After that, how things have played out. So the next 2 policies still gives us almost 4 months of global developments and our own growth inflation data to parse. And whether there is scope for more rate cuts after that, I think, by the October policy, half the year will be done. We'll have a lot more information on global growth, domestic growth. And, I'm not certain at this point that more than 50 bips additional is warranted.
Okay, well, the 2 ladies are not in my camp, but I want to persist about this double cut in June. And let me ask Devang, let me see the gentleman out on my side. Devang, the market itself, the 10-year paper is standing at 6.41. Is the market pricing in a sharper cut in June? What's your sense?
Oh, Latha, you're right. I think markets are now pricing in aggressive rate cuts. In fact, the swap curves are already pricing in more than 30 basis of rate cuts in the next policy, totally pricing in more than 50 basis of rate cuts. So our perspective is, yes, I think bond markets have been happy over the last couple of months, especially in the last 1 month, we have seen 30 basis of rally largely, on account of a couple of things. I think, first of all, 2 key messages for me from the RBI policy itself, along with the inflation data today, is that because the near-term inflation is significantly lower, the policy tilt is towards growth. And any delay in tariff implementation leads to a mar on growth. I think, in fact, they are optimistic at 6.5 today also when they are projecting next year's growth. So that will surprise. In fact, the growth data might give us more positive vibes on what rate cuts to price in. Second perspective is that I think he messaged this in his public conference also, where he's trying to keep minimum liquidity of 1% of NDTL. Now, persistent more than 1% of NDTL liquidity, last we had seen in COVID environment, where we are talking about an absolute terms of 2.5 to 3 trillion of liquidity. That kind of liquidity comes into the market. I think that will be very, very positive for bonds. And we can see, irrespective of 25 basis or 50 basis, I think probably bond markets will continue to rally, and we can see a 6-quarter on 10-year very soon.
Okay, when you say the growth number will be a positive surprise for inflation, you mean that growth will disappoint, and therefore, right? Okay.
Sorry, positive for bonds. What I meant was positive for bonds.
I take your point. Positive for bonds. I agree with your 1% for NDTL. I tried very hard to price that number from the governor in the press conference, and he finally coughed up that number. So that clearly is a positive for the bond markets. Samir, I wanted to present Devang's point as well to you. The IIP number that we got was particularly disappointing at 2.9%. The consumer goods numbers were especially bad. The consumer non-durables was negative. It was a contraction. Consumer durables was positive, but I think it was about 3.8 or thereabouts, a very disappointing number. Other than capex and infrastructure, both of which are government-driven, the other numbers, primary goods, intermediate goods, all of them were in low single digits. Would growth be a good reason for the Reserve Bank to move forward with a double cut? That's a 50 bips cut in June.
So, Latha, you're right. Even the last quarter's number compared to what the MOSPI is anticipating around about 7.6, the HFIs right now are indicating closer to 6.5. If you take the Kumbh effect, which is not too much visible in the HFIs, it could be 7%, so it will be lower than what the MOSPI is.
One minute. What is HFI?
High frequency indicators, sorry.
Okay, sorry. Yeah, go ahead. What is not evident in the high frequency indicators? Not much of growth from the Kumbh demand, is it?
Yes, yes. So even if you take the baseline at 6.5, our baseline before the Trump tariffs came in for the next year was also 6.5. The impact of the Trump tariffs on India is muted, but still it will range between 0.1 to 0.3. Earlier, we were looking at 0.3 when the April 2 announcement happened. Now, given that reciprocal tariffs on India are only 10%, and along with other countries, the impact is limited. But there will be second-order effects as well. So overall, put together, yes, growth will have a downside bias. But we still believe growth will sustain above 6% in each of the foreseeable quarter. And that implies that you don't need to do double cuts right now. You need to keep your firepower with you depending on how the situation is evolving. If there are more headwinds facing us, perhaps you use it then rather than right now.
Okay. All right. Well, I don't have a casting vote over here, but it's the four economists. And it looks like it's a 3-1 in favor of a 0.25% cut. But Aditi, would you not worry that there are deflationary forces at work, that growth is actually indicating a serious amount of weakness at this point in time? And given that uncertainties, even private investment, even if it is given a low of interest rate, may not pick up because of the uncertainties. So isn't growth a good reason for the Reserve Bank to give a double cut?
So Latha, let me offer a few thoughts over here. If we look at what already has been done in terms of fiscal policy, we've got the cut, the relief on income tax, which already had come in the budget. And now initially we were looking at 50 basis points of cuts in this cycle, which have already happened. We're talking about at least 50 basis points more. So a lot more monetary easing is already on the cards than what we would have probably thought 3 months back. And this again would be at least something that is going to support private consumption and things like, residential real estate, etc. In terms of government capex, we've got a fairly decent number coming in from Government of India in terms of the capex growth. I think the key really is going to be front loading it and getting it off the ground as early as possible this year as compared to last year, where the election and then the rains had really kind of pushed capex to the second half. Third point on state government capex, I think the FY25 RE numbers are extremely optimistic. When we're looking at the 11-month data, there is very little chance that in aggregate the states are going to be able to achieve their FY25 RE. And the headroom, therefore, in their FY25 BE to grow is very, very high. I'm taking that as a positive, that we could end up getting a lot of high capex growth, especially in the early months from the state governments. So from the domestic impulses point of view, there are a lot of palliatives or a lot of factors that can buffer what is clearly going to be high uncertainty in a very disruptive year. Exports, we saw the initial data that has come out for merchandise exports for March. I was a little surprised. I thought we were going to end up seeing a lot of front loading of shipments, but that really hasn't come through in the March trade data. So I don't know if that's going to come through in the April trade data, in the first week or 10 days of April. Maybe there is still some sort of bunching up that we're going to see on the export side. The other factor where I'm still a little positive is that the services exports numbers have been doing really well in the last few months. So maybe that will come under some pressure now because of the overall uncertainty on IT budgets, etc. But I think it's not a very panicky situation for us. Given what's happening globally, I think there are domestic buffers. There is fiscal policy that is going to be supportive. So I'm not sure that we need to overcompensate from the monetary policy side. I don't think there is a requirement for that, at least right now.
Okay. Well, I take your point about probably government capex. But government capex, center and states put together, is not a very big percentage of India's capex. I mean, ultimately, government capex is not even 3% of GDP, and our, gross fixed capital formation is well over 30%. So where is government in the whole scheme of things? It can't move the needle that much. And as you point out, we've got the trade data, and that's also indicating that exports are probably already under pressure. It's barely, it's flat if you compare it from year-ago levels. And this is not even the start of the tariff war. We're probably going to see it in the months to come. Though, of course, the next 3 months could be an extraordinary performance with people front-loading their exports. That possibility also exists. We have to take a break. And after that, let me get from my guests what are their growth expectations and their inflation expectations for the coming quarter. We're back in a jiffy.